Scott Davis, Lessons from the Titans. What companies in the new economy can learn from the great industrial giants to drive sustainable success. Discover the secrets of managing sustainable success in the ever-evolving world of business through the lens of the book, Lessons from the Titans. With insights drawn from the experiences of industrial giants like General Electric, Boeing, Honeywell, and United Rentals, this summary unveils key strategies for risk management, cash flow optimization, cost control, workforce development, and much more. Delve into the highs and lows of these companies, as their successes and failures offer valuable lessons for businesses across industries.
Jack Welch's GE, The Power of Bets. Jack Welch, former CEO of General Electric, took over a century-old company with a bloated management structure. He implemented a cost-cutting strategy that successfully reduced headcount by 25% and increased annual revenues by 30%. Welch's RCA deal, which left Wall Street analysts puzzled, included selling off assets and GE's consumer electronics branches to profit from NBC, its TV network. He then used the profit to bet on growth projects, such as the development of the CFM56 engine in partnership with Boeing, making it one of the top-performing products in American history. Welch's second major bet involved boosting the efficiency of the F-Series power turbine, which turned it into a high-margin product with investors scrambling to get a share of it. Jack Welch's strategic moves helped propel GE to industry dominance. GE Capital, the highs and lows. During Jack Welch's leadership, General Electric experienced tremendous success with GE Capital, which was responsible for a significant portion of the company's earnings. However, the lack of regulatory oversight and creative accounting practices led to the illusion of stability, masking the increasing risk of the venture. By the time Jeff Immelt took over, GE Capital was already in decline, contributing to the company's fall from industrial stardom. GE's culture of hubris and intimidation. GE's decline can be attributed to a culture perpetuated by Jeffrey Immelt that discouraged criticism, favored big ideas over practical investments, and prioritized protecting the company's image over manufacturing quality. GE's financial statements puzzled analysts and debt rating experts, but the SEC never intervened due to the company's size and lobbying clout. GE's culture extended to scare tactics used on analysts, resulting in a buy rating for the company's stock that created a bubble leading to the 2008 financial crisis. The economy's collapse hit GE hard due to the debt accumulated through GE Capital, leading to the elimination of the company's stock dividend and a decline in share price. Although GE has regained some credibility, questionable acquisitions have hindered a full recovery, and the end of Immelt's tenure as CEO was sealed by the purchase of a near-bankruptcy Alstom Power. Boeing's risky flight. Boeing's quest for profitability and reduced risks culminated in mixed success, as seen in the tumultuous journey of its 787 Dreamliner manufacturing costs, and the 737 MAX passenger aircraft. CEO Jim McNerney's de-risking the decade plan reduced Boeing's risk and liabilities by halting high-risk projects and eliminating loss-making contracts. His successor, Dennis Muhlenberg, aimed to increase Boeing's profits several-fold through strategies like lower manufacturing costs achieved by insourcing Boeing's airplane parts. However, Muhlenberg's cost-cutting measures led to the expedited manufacture of the faulty 737 MAX, leading to 2 fatal crashes and grounding of 90% of all planes due to the COVID-19 pandemic. Boeing's new CEO, David Calhoun, tried to revive the company, but the odds remained stacked against it. Turning a corporate giant around. When Dave Coate became CEO of Honeywell in 2002, the company was in disarray, facing lawsuits over asbestos liabilities, rising debts, and an economic decline. Despite the challenges, Coate transformed the company by cutting costs, developing new products, and expanding into new markets. He hired a new CFO, got the shaky accounting under control, and settled most of the asbestos lawsuits. Instead of trimming headcount, he limited most new hires to areas with large growth potential and localized production. Coat implemented better manufacturing practices and quality control benchmarks and reserved R&D funds for high-growth products. Aggressive acquisition and selling smaller businesses helped lead Honeywell to a 20% profit margin in 2017, a significant increase from 11% when Coat took over. The rental revolution. United Rentals transformed its business model and operations to become a successful rental company under CEO Mike Nealon's leadership. United Rentals is a company that rents out industrial equipment to other businesses instead of developing and selling products to customers. Despite the clear market for such services, the company's stock prices plummeted when Mike Nealon assumed the role of CEO in 2008. He aimed to turn the company around by utilizing the Great Recession's lousy rental market and restructuring the company from the bottom up. Nealon's first order of business was to address the decentralized management structure resulting from over 200 acquisitions of smaller rental companies. Before Nealon arrived, branch managers were compensated based on profits before expenses, which promoted unnecessary equipment purchases. He restructured the compensation scheme to encourage greater cooperation between branches by tying 70% of managers' compensation to district results rather than branch results. Next, Nealon introduced new IT solutions to digitize and centralize pricing, contracts, order taking, and insurance policies. Previously, the company didn't have a standardized system, with mobile devices generating prices on a case-by-case basis. Lastly, he established a culture of continuous improvement, making use of Kaizen, a Japanese business philosophy that values improving everything a little at a time. United Rentals held over 500 Kaizen events between 2014 and 2015, finding efficient solutions to tiny problems. These improvements were not free, with the company's debt increasing from $3 billion in 2008 to $12 billion in 2018, but its profits rose much faster. United Rentals also acquired 4 of its competitors easily due to its optimized business model and operations. In conclusion, United Rentals was transformed under CEO Mike Nealon's leadership, utilizing reforms, continuous improvement practices, regional cooperation, digitization, and restructuring to become a successful rental company. Key principles for business success. Successful companies, regardless of industry, commonly adhere to basic principles such as managing costs and risks, leveraging lean systems for efficiency, prioritizing talent acquisition and fostering a culture of continuous improvement, and making responsible investments. General Electric suffered when it neglected these principles. To prevent this, companies should adopt lean systems, effectively manage talent, and invest in deals with a tangible return. Ultimately, success boils down to implementing and sticking to these basic principles.
In conclusion, Lessons from the Titans imparts valuable wisdom from the experiences and performances of major industrial giants. The key to sustainable success lies in managing costs and risks, increasing cash flow, and effectively deploying capital resources. By adopting lean manufacturing systems, cultivating a culture of continuous improvement, and investing capital responsibly, businesses can thrive in an ever-changing economy. By learning from the industry leaders, both new and established companies can tailor these strategies to navigate the dynamic business landscape and shape their own path to success.